Hi, I'm Seth Freuberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So this week I'd like to talk about diversification for market neutral options traders. This is a very important topic because if you get yourself too concentrated, too much of your capital concentrated in any particular niche, it's a little dangerous. And you can suffer a large loss and then never be able to either psychologically or financially recover from that. So it's a good idea to spread things out and to diversify. I've talked different times about the different types of diversification. There's diversification as to vehicle. For example, you can diversify what you trade. You could trade indexes, you could trade a particular index, you could trade commodities, you could trade individual equities, currencies, etc. So that's a form of diversification. The second type of diversification I like to talk about is time diversification, and that is where you initiate your trades farther or closer to a particular option's expiration. By diversifying when you start your trades, you've diversified from a time standpoint. Another form of diversification is price diversification. You could enter 2 or 3 trades in the same week, but if the market's really moving around that week, you've actually entered trades at different price points as well. So that's another very important form of diversification. You can also diversify as to strategies. You can do iron condors and double diagonals and calendar spreads and broken wing butterflies or whatever. And by diversifying as to strategy, each strategy has its own strengths and weaknesses, and therefore you've achieved diversification by diversifying the different strategies you're trading. And then finally, there's diversification as to the way your trade responds to options implied volatilities. So calendar spreads, for example, are long vega, meaning it responds well to an increase in volatility, and whereas a front month or same expiration butterfly is a negative vega position and responds poorly to increases in options volatility. So that is an example of how you could have 2 different trades with 2 different responses to implied volatility and therefore have diversified in that way. So today I want to focus on time diversification because something has changed in the option world that gives you a unique ability to take advantage of time diversification like you never have before, and that's the advent of weekly options. And when these first came out, there was not enough of a open interest in the weekly options so that it was that viable. It was a little bit dangerous to trade those because there wasn't enough trading going on at the individual strikes to make sure that you could get in and out of the position, particularly out. But now, since weeklies have been around much longer, they are much more viable and there's much more trading going on at the different strikes in the different options chains. So because the weekly options have become more popular and because they're therefore more viable for trading, you've got some opportunities that have opened up that didn't exist, say, 7, 8 years ago in options, market neutral options trading. So, but now let's take a look a little bit more deeply and drill down more deeply, because most people, when they hear about weekly options, they think, oh, this is great. I don't have to wait a month or 2 to find out how I'm going to do on a trade. The whole shooting match is over in 7 days. Well, that's if you're trading weekly options in the last, say, 7 to 10 days of that weekly options chain. And what I have observed over time is that most people who trade weekly option strategies that way, where they're trading in that final week of expiration, which has extremely high gamma, under those circumstances, most people will, the pattern I've seen is they do well in a strategy for a while, and then unfortunately they usually blow up. It doesn't happen every time, and I'm sure there are exceptions out there, and I'm sure there are strategies that have been developed that defies this, but essentially a week's worth of time premium is usually not enough to absorb a gigantic overnight market move. So therefore, that is a problem with trading the last 7 to 10 days of weeklies, which is how people initially responded to the advent of weekly options. Personally, I think it's a little dubious, but there may be strategies out there which are making this work. I just haven't seen very many of those. But there is another opportunity that I think is very healthy and very sound, and that is using the weekly options chains to put trades on every week, but not in this last 7 days of that options chain, but instead putting that trade on 60 days in advance or 45 days in advance. And what more and more traders are doing, in fact, we've added a number of traders to our desk recently who are doing just that. They are starting out very far out in time using the weekly options chains, which are now viable because of enough open interest, and they are opening their trades, let's say, 70 days out from expiration, and they're closing them 40 days out from expiration. So they never experience that high gamma period, and then they take that capital that they've closed 40 days out and roll that into another trade that starts 70 days out. So therefore, they're using the weekly options chains, but for almost the exact opposite reason you would have expected them to be used for. They're being used so that people can throw a trade on every week and always be 70 days out or always be 45 days out, because there's these days almost always an options chain coming up that will satisfy a particular distance from expiration desire that you may have to trade. So we have another trader here at SMB who trades iron condors 45 days out, but he throws one on every week, splitting his capital up between lots of different time periods, but getting the advantage of the exact same economic dynamics of being out 45 days as opposed to being out 7 days. And so it's a big, big advantage. It gives you an ability to diversify your capital every week. You can split your capital up into pieces, fractions, in order to be able to trade portions of that capital every week, not therefore exposing any one amount of your capital to one particular price point in the market. So it's a really terrific opportunity that's opened up in the marketplace, and we're becoming more interested here at SMB's Options Trading Desk. There are certain strategies that are sort of designed around this. For example, many of you have heard of the road trip trade. That's a good example of a strategy that's designed around splitting your capital up and keeping it very far out in time and being able to take advantage of these weekly options chains. So in summary, the advent of the weekly options chains allowed this unique concept to emerge of throwing trades on every week but being able to be distant from them in time. This allows you to diversify your capital along a wide spectrum of prices, and we're getting very interested in this at SMB. We are finding that traders who trade this way are experiencing a good deal of success. They're far out from expiration. They're rolling their capital far out from expiration. But because of the weekly options chains and the proliferation of the open interest on those, our traders are able to viably trade those strategies. So it's something I think you should think about for your own personal trading. Do you have an ability to split your capital up, diversify it, basically lay bets down at different points in the calendar and different price points in the market? And that way you've taken time diversification and you've sort of taken it to the ultimate. You split your capital up in so many ways that you're not going to get hurt, hopefully, too badly in any one particular time period. Now, you do have to worry about how many trades you have on and whether you can handle them all in the context of a big market move. So that's something to think about. But if you are comfortable trading 4 or 5 positions at the same time, some of which won't be at all affected by a big move and others of which may be, then this is a viable concept for you to consider. So think about doing that. We're taking it very seriously here at SMB. And you know, as always, we put our money where our mouth is, and so I can, in good conscience, suggest that you maybe take a look at this for your own personal trading as a further way to diversify your options trading strategies. So thanks very much, and we'll see you next week.